Welcome to Module 2.4. We're going to look at what is leverage in Forex trading. Leverage is what attracts most of the traders into Forex market, most of retail traders at least. But this is very unfortunate because they come after seeing those Instagram and Facebook ads with rented sports cars and mansion. Unfortunately, if you follow one of them, you will get a rude awakening that leverage is a dual-edged sword. It's no better than gambling at the casino. But don't worry, I'm going to teach you how to use leverage wisely in your trading plan. So let's get started on our lesson. Now let's take a look at what is leverage. Leverage is basically a loan from the broker that will give you ability to control large position sizes beyond your cash balance of your account. So basically, if you have $1,000 in your account and if you are getting a 50-to-1 leverage from your broker, you will be able to trade $50,000 in value. Trading with Forex leverage. Okay, let's say we have an account size of $1,000 and we are trading Euro US. As we know from the earlier lessons that Euro US pip value is about $10 per standard lot. How much we could trade when our broker offer a 20-to-1 leverage. When our broker offer 20-to-1 leverage, it's a value of $20,000 we could trade. So that means we could trade a maximum of 2 mini lots, which is about $2 per pip value. When it's 50-to-1, we could trade $50,000 and we could trade 5 mini lot and $5 per pip value. And when it's 500-to-1, we could trade $500,000 and a maximum lot size of 5 standard lots and if $50 for pip value. As you could see from this chart here, as we increase the leverage amount, our risk and reward also increases. That's why I said earlier, leverage could be a dual-edged sword. So let's go and take a look why it could be a dual-edged sword. Leverage is a dual-edged sword. Okay, let's take a look at this bad example usage of a leverage. So if we are trading Euro US with the $1,000 account with the leverage of 500-to-1 from our broker, this means we could control 500,000 of the base currency or the maximum of 5 lots. The pip value we know from earlier pip value calculation lessons is about $10 per pip. If it's 5 lots, it's about $50 per pip. So the leverage we are using is 500-to-1. We could control 500,000 and the lot size is about 5 maximum and $50 is per 1 pip. So in this case, let's say we analyze everything, put in a trade according to our strategy. The trade goes against us about 20 pip before it moves in our favor. So when it moves about 20 pip down, we have already wiped out our account because it's $50 for a pip. 20 times 50 is $1,000. Even though our broker is giving us 500,000 as leverage, they're not going to let us dig into their money when our trade is losing money. So the margin call will kick in at that time and your account wouldn't have been wiped out at that time. So let's take a look at a good use of leverage in our next slide. Okay, let's take a look at a wise use of leverage. We are trading Euro US with a $1,000 account and we are only getting a 10-to-1 leverage from our broker. This means we could control 10,000 in value, which means we could control a mini lot. Pip value for a standard lot is about $10. For a mini lot, it would be $1. So the leverage is about 10 to 1. The value we could control is 10,000 and the lot size is 0.1, which means a pip value of $1. Just in case the trade goes against us 20 pip before it moves in our favor, we are only down about 2% instead of the full account size in the example we saw earlier. Okay, we are at the end of module 2.4. We looked at what is leverage, how not to use leverage, and how to use it wisely. We're going to take a look at how to use it wisely more in depth in risk management section of this course and also with each strategies. Now we're just going to move on to margin in Forex.